You have spent a lifetime building wealth. Now you want to make sure as much of it as possible actually reaches your children rather than disappearing into taxes, legal fees, and family conflict. But when you start looking into it, estate planning feels overwhelmingly complex. Wills, trusts, gift taxes, estate taxes, probate. Where do you even begin? And here is the question most people never stop to ask. If you died tomorrow without any plan in place, what would actually happen to your assets? Your children might spend years fighting over who gets what. They might pay far more in taxes than necessary. The assets might not go to the people or purposes you intended. Today I am going to give you a clear, practical guide to passing your wealth to your children in the most effective way possible. This is not just for the wealthy. Whether you have a modest estate or a substantial one, the difference between planning and not planning is enormous. Let me start with the fundamental concept. There are two primary ways to transfer wealth to your children. Giving while you are alive, which is called gifting or making gifts. Transferring after death, which is called inheritance or estate transfer. Understanding the difference between these two approaches and when to use each is the foundation of everything. Which is better, gifting now or leaving assets at death? There is no single correct answer. It depends entirely on your situation. But in general, early planning and gradual gifting over time tends to reduce the overall tax burden significantly. The reason is straightforward. Large transfers in a single event face the highest tax rates. Smaller transfers spread over many years allow you to use annual exclusions and lower tax brackets more effectively. This is the core principle of estate tax minimization. Let me walk you through how the American system works. Since many of you are watching from or planning for the United States, the annual gift tax exclusion for 2024 is $18,000 per recipient. This means you can give any individual up to $18,000 per year, completely free of gift tax. Your spouse can do the same. So a married couple can, together, give one child $36,000 per year without any tax consequence. If you have 3 children, that is $108,000 per year, leaving your estate entirely tax-free. Over 10 years, that adds up to over $1 million, transferred without triggering any gift tax. This is the simplest and most accessible tax-free wealth transfer strategy available to almost any family. The federal estate tax exemption is extraordinarily generous in the United States for 2024. The exemption is approximately $13.61 million per individual. A married couple can together shelter approximately $27.22 million from federal estate tax. However, this exemption is currently scheduled to be cut roughly in half after 2025, when provisions of the Tax Cuts and Jobs Act expire. This potential change makes planning now particularly important. Estates above the exemption amount are taxed at up to 40%. Now here is the insight that surprises most people. It is not just about how much you give, but when you give it. Assets that are likely to appreciate in value are more tax efficient to give away early. Here is why. If you give your child stock worth $100,000 today, and it grows to $300,000, the $200,000 appreciation happens entirely in your child's hands. You only used $100,000 of your gift tax exemption. If you had held the stock until death, the full $300,000 value would count against your estate exemption. The earlier you transfer appreciating assets, the more of your exemption you preserve for other transfers. Beyond cash gifting, there are several powerful wealth transfer strategies worth understanding. The first is your will. Without a will, your assets are distributed according to your state's intestacy laws. These laws make assumptions about what you want that may bear no resemblance to your actual wishes. A will allows you to specify exactly who receives what. It allows you to designate guardians for minor children, It allows you to direct that specific assets go to specific people. Without one, a court makes these decisions for you. Every adult, regardless of wealth level, needs a basic will. It should be professionally drafted and witnessed according to your state's requirements. Review it every few years and after any major life event. The second is a trust. A revocable living trust is one of the most versatile and valuable estate planning tools available. Unlike a will, which goes through probate, assets held in a trust transferred to your beneficiaries directly. Probate is the court-supervised process of validating a will and distributing assets. It is public, potentially costly, and can take anywhere from months to years. A trust bypasses probate entirely. Assets transfer quickly, privately, and without court involvement. A trust also gives you much greater control over how and when your children receive assets. You can specify that a child receives funds only upon reaching a certain age, or that distributions are made incrementally over time, or that funds can only be used for specific purposes, like education or a home purchase. For blended families, second marriages, or situations where there are concerns about a child's financial maturity, a trust is often essential. The third is life insurance. Life insurance is a uniquely powerful wealth transfer tool. The death benefit passes to your beneficiaries completely free of income tax. If structured correctly, it can also be kept outside your taxable estate. This is accomplished through an irrevocable life insurance trust, or ILIT. When your life insurance policy is owned by an ILIT rather than by you personally, the death benefit is excluded from your estate for tax purposes. This can be extraordinarily valuable for large estates. Beyond tax efficiency, life insurance provides immediate liquidity to your heirs at a time when they may need cash quickly to pay estate taxes, settle debts, or simply manage living expenses during the transition. The fourth is retirement account planning. Who inherits your IRA or 401k matters enormously for tax purposes. The rules around inherited retirement accounts change significantly with the Secure Act. Most non-spouse beneficiaries are now required to withdraw the full balance of an inherited IRA within 10 years. This can push your children into higher tax brackets if they are in their peak earning years. Consider the tax implications of who inherits retirement accounts versus taxable accounts. Converting traditional IRA funds to a Roth IRA during your lifetime can be advantageous. Your children inherit Roth accounts tax-free. Whether conversion makes sense depends on your current tax rate versus your children's expected tax rate. The fifth is real estate transfer strategies. Real estate can be transferred in several tax-efficient ways. Gifting real estate directly uses your annual exclusion or lifetime exemption. A qualified personal residence trust, or QPRT, allows you to transfer your home at a discounted gift tax value, while retaining the right to live there for a specified number of years. Adding your children to the title as joint tenants with right of survivorship allows the property to transfer automatically at death without probate. Understanding the stepped-up basis rules is critical. Assets transferred at death receive a stepped-up cost basis to their fair market value at the date of death. This eliminates the capital gains tax your heirs would otherwise owe on appreciation that occurred during your lifetime. This is one of the most significant tax benefits of holding appreciated assets until death rather than gifting them. Common mistakes to avoid. The first mistake is doing nothing. This is by far the most costly mistake. Dying without a plan leaves your family with confusion, conflict, and unnecessary expense. The second mistake is failing to update your plan. A will or trust drafted 20 years ago may not reflect your current wishes, family situation, or financial circumstances. Review your documents after every major life change. The third mistake is not coordinating beneficiary designations. Retirement accounts and life insurance policies pass by beneficiary designation. not by your will. If your beneficiary designation names a deceased person or an unintended recipient, no will or trust can override it. Review all beneficiary designations regularly. The fourth mistake is gifting assets you will need. Do not give away assets that you may need for your own care and living expenses. Medicaid planning adds another layer of complexity here. Assets gifted within 5 years of applying for Medicaid may be counted against you. Consult an elder law attorney if this is a consideration. The fifth mistake is not communicating with your family. The most technically perfect estate plan can still cause family conflict if your children do not understand your intentions. Have honest conversations with your family about your wishes, not necessarily the specific dollar amounts, but the reasoning behind your decisions. Understanding why matters as much as knowing what. I want to close with this. The most valuable thing you can pass to your children is not money. It is values, work ethic, family relationships, and the example of a life well lived. But after that foundation is in place, making sure the financial assets you have built reach them efficiently and without unnecessary conflict is a genuine act of love. Start with a conversation with an estate planning attorney. Get a will in place. Review your beneficiary designations. Consider whether a trust makes sense for your situation, and talk to your children. The earlier you start, the more options you have. The more options you have, the more you can protect.